Let's start with the main indices. The S&P 500, represented by SPY, closed at 691.66, down a fractional 0.08%. Its tech-heavy cousin, QQQ, mirrors this weakness precisely, also at minus 0.08%. This suggests a market consensus hovering right around flatlining, a collective holding of breath after a busy news cycle. But wait, the picture isn't entirely flat. Look down the capitalization ladder. The IWM, tracking small caps, managed a tiny gain of plus 0.09%. This is the first little crack in the narrative. When the giants, the mega caps that drive the SPY and QQQ, are stagnant or slightly down, but the smaller, more domestically focused companies are nudging up, it suggests that some segment of the market still sees value or opportunity closer to home, away from the major geopolitical and big tech narratives. Now, let's turn to the fear gauge. The VIX, our beloved index of implied volatility, shot up by a staggering plus 18.79% to 18.84. This is a massive jump. A VIX reading hovering near 19, accompanied by a relatively flat S&P 500, tells a dramatic story. Anxiety is running high, but sellers haven't fully committed to the panic button yet. People are nervous, they are buying protection, but the actual sell-off in the broad index hasn't materialized commensurately. It's the sound of tightening seatbelts before a known rough patch of air. Connecting the dots, we have flat major indices, elevated fear, and resilient small caps. This isn't a strong bull market, nor is it a clear bear market. It's a market deeply uncertain about which way the macro winds are blowing. Our uncertainty is mirrored in the statements and actions of the people who steer the global financial ship. The VIP section today is a veritable Davos reunion mixed with Silicon Valley drama. We see Jerome Powell, the Fed chair, slated to attend a Supreme Court argument, a bizarre crossover that reminds us that even monetary policy is often entangled with the highest levels of governance. But the real forward guidance is coming from the Fed officials themselves, one of whom is signaling openness to more interest rate cuts this year. This is a huge signal that cuts are not off the table, despite what the recent inflation data suggested. Speaking of inflation, the US inflation CPI held steady, and so did expectations for a Fed pause. This is the core tension. If inflation is steady, the Fed should pause. But if Fed officials are open to cuts, they might be signaling a belief that the cooling labor market will eventually force their hand. And look at that labor report. US employers added 50,000 jobs in December, but the unemployment rate dropped to 4.4%. This is a mixed bag for the doves. Fewer jobs added suggests cooling, which the Fed wants to see, but a lower unemployment rate suggests the labor market is still tight, which argues against immediate rate cuts. The market is trying to reconcile the Fed officials' openness to cuts with the persistent strength shown in the jobs data. In the tech sphere, the titans are shifting focus. Jensen Huang of Nvidia is delivering a keynote at SAY, signaling the unstoppable momentum of AI infrastructure. But while Nvidia, as represented by its stock price, saw a slight dip of minus 0.44%, the sentiment is clearly captured by the headlines. AI stocks are still viewed as long-term plays, even if there's short-term profit-taking. Contrast this with Meta. Mark Zuckerberg is doubling down on AI by cutting 1,500 jobs in the Reality Labs division. This is a clear, ruthless reallocation of capital away from the metaverse bet and into the AI engine room. Kramer may call Meta a lone wolf, but Zuck is treating it like a scorched earth campaign focused solely on the winning technology. And then there's the capital allocation debate. A headline emphasizes that capital allocation matters more than earnings right now. This tells you the market is no longer rewarding revenue growth at any cost. It's rewarding smart deployment of capital, which explains why Warren Buffett's massive cash hoard is attracting criticism. The market demands action, not just sitting on reserves. If the equity market is expressing confusion, the bond market is expressing concern, primarily through the VIX spike. But let's look at the currency landscape, which often acts as a precursor to bond market moves. The EUR/USD exchange rate is up plus 0.59% to 1.17. This means the euro is strengthening relative to the US dollar. Why would the dollar weaken slightly when the Fed officials are signaling openness to cuts? Because if the Fed cuts rates, or even pauses aggressively while other central banks remain hawkish, the yield advantage of the USD erodes. This connects directly to global central bank action. We have a Croatian central bank chief nominated as the new ECB vice president. This signals continuity or a specific policy leaning within the European central bank structure. Furthermore, we see inflation data in Canada cooling, even as headline numbers were up. The theme here is divergence in policy expectations. The US economy is showing a mix of cooling, slowing job additions, and strength, low unemployment, making the Fed's path unclear. Meanwhile, global central banks are maneuvering. The market is sniffing out a scenario where the Fed might be forced to be more accommodative sooner than the market fully prices in, hence the dollar softening slightly against the euro, and the VIX spiking in anticipation of policy confusion. The Federal Reserve remains the gravitational center of market thought. The whisper of more interest rate cuts this year from a Fed official is the loudest signal we've received. This supports the idea that the jobs market, despite its current 4.4% unemployment figure, is seen by the Fed as potentially fragile enough to warrant easing later in the cycle. We also have the long-term philosophical debate surfacing, echoing Ray Dalio's warnings about a new monetary order. If global instability continues, fueled by geopolitical tensions and shifting reserve currency dynamics, the market will continue to look for hedges. Dalio's resurfaced warning about gold potentially shunning the US dollar's dominance isn't just noise, it's the background hum beneath every policy decision today. On the geopolitical front, Ursula von der Leyen is coordinating with the US on Ukraine peace efforts, emphasizing strong EU-US coordination. This implies stability in established alliances, which generally supports global trade flows, but it doesn't eliminate the underlying economic anxieties driving the VIX. We don't have hard commodity price action here, but we can infer their mood from the currency and volatility data. The strengthening euro suggests less immediate pressure on imported goods priced in dollars, which can ease headline inflation slightly. More importantly, the huge spike in the VIX tells us that geopolitical risk premiums are elevated. While we don't see crude prices explicitly, high geopolitical tension almost always means that energy costs are being eyed nervously by traders. The story isn't about what's happening in the oil patch today, but how much uncertainty the market is pricing into the next potential supply shock. Let's drill down into the stock movers, connecting the macro themes to the corporate action. The tech tug of war, MSFT is up plus 0.70%, and AMZN is up plus 0.39%. These two giants are showing positive momentum. Why? They are the bedrock of cloud computing and enterprise AI spending. Despite volatility elsewhere, the secular trend of businesses moving to the cloud and adopting AI tools, as championed by Jensen Huang, remains incredibly strong. They are seen as essential infrastructure, relatively insulated from consumer whims. In contrast, look at the high-profile dips. AAPL is down minus 1.04%. This is significant. While Apple is a behemoth, its recent performance has been less tied to the bleeding edge of AI infrastructure and more tied to consumer hardware replacement cycles. When uncertainty reigns, VIX up 19%, cyclical or consumer-dependent names often feel the pinch first. Tesla and crypto-adjacent plays. TSLA is down minus 0.24%. Cathie Wood is selling Tesla while buying AI chips. This reflects a growing bifurcation. The high-growth, capital-intensive, visionary stocks that haven't shown massive immediate profitability in the new AI paradigm are facing pressure, while the pure AI infrastructure plays hold steady or advance. The digital asset space is getting hammered, confirming the risk-off sentiment gripping the broader market. BTC USD is down minus 1.68% to $90,994, and ETH USD is down minus 1.96% to $3,124. When the VIX spikes, Bitcoin acts as a high beta risk asset. It's not acting as inflation hedge today, it's acting like a speculative tech stock that's correcting hard. Michael Saylor's legacy advice to throw it all in on Bitcoin is being retested in real time. Investors who are nervous about the Fed's path and job market stability are de-risking from the most volatile assets first. The fact that both Bitcoin and Ethereum are down roughly twice the percentage of the S&P 500 reinforces this narrative. The market is reducing exposure to speculation. The signals for tomorrow are contradictory, forcing traders to pick their narrative carefully. Narrative A, the Fed cuts path. If the market focuses on the Fed official signaling rate cuts, we could see a rebound in risk assets, crypto, IWM, and potentially pressure on the dollar. However, the strong jobs data slightly muddies this. Narrative B, the VIX spike dominates. If fear continues to grip, the VIX might sustain its move toward 20, forcing broader equity selling. The immediate focus will be on whether the strong performers, MSFT, AMZN, can hold their ground against the pull from the lagging names, AAPL, NVDA. The most telling data point will be the reaction to any further ECB or Fed commentary. We are in a data-dependent environment, but today, the fear data, VIX, is louder than the price data, SPY. Jamie Dimon visiting Palantir, a defense, intelligence tech player, is a fascinating subplot. It signals that Wall Street's major banks are increasingly engaging with companies sitting at the nexus of government contracts and cutting-edge data analysis. This aligns with Larry Fink's warning that capitalism must evolve. It must evolve to focus on essential security and technological dominance, not just consumer products. What have we learned in these last 12 minutes? The market is holding its breath near flatline, SPY, QQQ, because the macro signals are pulling it in opposite directions. Inflation is steady, but the jobs market is still tight enough to confuse the Fed's next move. This policy ambiguity is directly manifesting as elevated anxiety, seen in the plus 19% spike in the VIX. Money is fleeing the speculative fringe, crypto is down hard, and consolidating into proven, necessary infrastructure plays, MSFT, AMZN. The AI hype narrative is now being filtered through a rigorous lens of capital allocation, exemplified by Zuckerberg's job cuts and Cathie Wood's selling of Tesla. We are not in a consensus market, we are in a calibration market. The VIX is telling us that the baseline risk premium has increased significantly. Until the central banks offer clearer guidance on the path of least resistance for interest rates, expect this choppy, high-anxiety consolidation to continue. Stay nimble, watch the VIX closely, and remember, in times of confusion, prioritize the story of where capital is being deployed, not just where the overall index lands.